Most people think they're terrible investors, but what if I told you that you might already be crushing it compared to the average person? There are 9 specific behaviors that separate successful dividend investors from the crowd. And if you're doing even 5 of these, you're already ahead of 90% of investors out there. Some of these might surprise you because they're not what the financial media talks about. Let me show you exactly what to look for and why these signs matter more than your portfolio balance. Here's the reality that nobody wants to talk about. The average investor underperforms the market by about 3% annually. That's not because they're picking bad stocks or timing the market wrong. It's because they're making fundamental behavioral mistakes that compound over decades. But if you're watching this channel, chances are you're already doing things differently. I'm going to walk you through 9 specific signs that prove you're investing better than almost everyone else. These aren't the obvious ones like having a high return or a big portfolio. These are the subtle behaviors that create wealth over time. And if you want to keep building that edge, subscribe right now. I break down advanced dividend strategies and behavioral psychology every Tuesday and Friday, giving you the exact framework that separates successful investors from everyone else chasing quick gains. Let's start with something most people get completely backwards. Sign number 1. You actually read annual reports instead of just watching stock prices. Most investors treat the stock market like a casino scoreboard. They check prices multiple times per day, get excited about green numbers, panic about red ones, and make decisions based on how they feel about recent price movements. But here's what separates you from that crowd. You dig into the actual business. When Johnson & Johnson reports earnings, 90% of investors look at whether the stock went up or down that day. But you're reading through their 10K filing, checking their dividend coverage ratio, looking at their debt levels, and understanding their pharmaceutical pipeline. You know that J&J has increased their dividend for 61 consecutive years, not because of stock price momentum, but because of consistent cash flow generation and prudent capital allocation. This behavior puts you in an elite group because you're making investment decisions based on business fundamentals rather than market emotions. While others are reacting to headlines, you're analyzing whether a company can sustain and grow its dividend payments over the next decade. Sign number 2. You view market crashes as shopping opportunities, not disasters. Here's where I need to tell you something that might shock you about what happened during the March 2020 crash, but first, let me ask you this. What was your first instinct when the market dropped 34% in just over a month? Most people panicked and sold. Some people froze and did nothing. But if you're in that top 10%, you probably started making a shopping list. During that crash, while everyone else was watching their portfolios bleed red, successful dividend investors were calculating which high-quality companies were suddenly trading at discounts they hadn't seen in years. They weren't worried about catching a falling knife or timing the bottom perfectly. They were focused on one thing: buying great businesses at temporarily depressed prices. Think about Microsoft trading at under $160 in March 2020, or Apple below $250. These weren't broken companies with failing business models. These were temporary price dislocations created by fear and forced selling. The investors who recognized this and acted on it didn't need perfect timing. They just needed the discipline to buy when others were selling. This mindset separates you from the crowd because it requires a fundamental shift in how you think about volatility. Most people see market drops as wealth destruction. You see them as wealth transfer from the emotional to the patient. Sign number 3. You focus on dividend growth rates, not just dividend yields. Walk into any investment forum and you'll see people bragging about finding stocks with 8, 10, or 12% dividend yields. They're chasing the highest number they can find, thinking bigger yield equals better investment. But this reveals a fundamental misunderstanding of how dividend investing actually works. You know better. You understand that a company paying a 12% dividend yield is probably in serious trouble. Either the stock price has crashed because the business is failing, or management is paying out an unsustainable portion of their earnings just to keep investors happy. Both scenarios end badly. Instead, you're looking at companies like Microsoft, which yields only about 0.7%. That seems pathetic compared to a high-yield stock, right? Wrong. Microsoft has increased their dividend by an average of 10% annually over the past decade. That means your yield on cost grows exponentially over time. If you bought Microsoft 10 years ago, you're now earning over 2% annually on your original investment, and that percentage keeps growing. This long-term thinking puts you ahead of 90% of investors who get seduced by today's high yield without considering tomorrow's dividend cuts. Sign number 4. You reinvest dividends automatically without thinking about it. Most people treat dividend payments like found money. The check hits their brokerage account and suddenly they're thinking about what to spend it on, or whether they should wait for a better entry point to reinvest. This seemingly innocent behavior costs them massive wealth over time. You've set up automatic dividend reinvestment and forgotten about it. This simple decision compounds your returns in ways that most investors never fully appreciate. When Coca-Cola pays you a dividend, that money immediately goes back into buying more Coca-Cola shares, which generates more dividends, which buys more shares, creating an endless compounding loop. Let's look at real numbers. If you invested $10,000 in the S&P 500 30 years ago and spent all the dividends, you'd have about $74,000 today. But if you reinvested those dividends automatically, you'd have over $250,000. That's the power of compounding that you're harnessing while others are spending their dividend checks. Sign number 5. You know the difference between a dividend cut and a dividend pause. Here's something that reveals advanced dividend investing knowledge. You don't panic when a quality company temporarily reduces or eliminates their dividend during a crisis. Most investors see any dividend action as a red flag and immediately sell, but you understand the nuance. When Disney suspended their dividend in May 2020, amateur investors dumped the stock thinking the company was finished. But you recognize this as a cash preservation move during an unprecedented shutdown of their theme parks and cruise lines. Disney wasn't a failing business. They were managing through a temporary crisis. Sure enough, they resumed dividend payments in 2021, and the stock recovered. This ability to distinguish between temporary dividend actions and permanent deterioration of business fundamentals puts you way ahead of reactive investors who treat all dividend news the same way. Now, we've covered 5 signs that you're investing better than most people, from reading annual reports to understanding dividend strategy nuances. But here's where things get interesting. The next 4 signs are actually counterintuitive behaviors that seem wrong on the surface, but are exactly what separates elite investors from everyone else. And one of these behaviors might completely change how you think about portfolio construction. Sign number 6. You own fewer stocks than most people think you should. Conventional wisdom says you need 20, 30, or even 50 different stocks to be properly diversified. Financial advisors love to talk about not putting all your eggs in one basket. But successful dividend investors often concentrate their holdings in fewer, higher quality companies. You might own just 15 to 25 dividend-paying stocks, but each one is a company you understand deeply. Instead of owning a tiny position in every dividend aristocrat, you've concentrated your investments in businesses where you have high conviction. This focus allows you to monitor your holdings effectively and really understand what drives their business performance. Warren Buffett has said that diversification is protection against ignorance, but concentration is protection against mediocrity. When you know your company's inside and out, you don't need to own 50 different stocks to manage risk. You manage risk by owning great businesses at reasonable prices. Sign number 7. You're comfortable holding cash when you can't find good opportunities. This one drives financial advisors crazy, but successful investors sometimes hold significant cash positions. Not because they're trying to time the market perfectly, but because they understand that deploying capital requires patience. You know that being fully invested at all times isn't actually a requirement. When quality dividend stocks are trading at historically high valuations, you're comfortable waiting for better opportunities rather than forcing investments just to put money to work. This patience prevents you from buying mediocre companies at expensive prices just because you have cash burning a hole in your portfolio. During periods when everything seems overvalued, holding cash gives you the flexibility to act when opportunities finally present themselves. Most investors feel pressured to always be fully invested, But you understand that sometimes the best investment decision is not investing at all. Sign number 8, you track your dividend income growth, not just your total return. While most investors obsess over their portfolio's total value and how it compares to the S&P 500, you're focused on a different metric: how much dividend income you're generating compared to last year. This shift in focus changes everything about how you invest. You might be earning $3,000 annually in dividends this year compared to $2,700 last year. That 11% growth in dividend income is more important to you than whether your portfolio beat the market by 2% or lagged it by 1%. You understand that growing income streams create financial independence, not portfolio appreciation that you might never realize. This income focus also changes how you evaluate investments. Instead of asking, will this stock go up? You're asking, will this company be able to pay and grow its dividend for the next 20 years? It's a completely different investment framework that leads to different stock selections and different holding periods. Sign number 9. You have a specific dividend income target, not just a net worth goal. Most people invest with vague goals like save for retirement or build wealth, but you've calculated exactly how much annual dividend income you need to cover your expenses, and you're working systematically toward that number. Maybe you've determined that you need $48,000 annually in dividend income to maintain your current lifestyle. At a 4% average yield, that means building a $1.2 million dividend-focused portfolio. This clarity changes everything about how you invest because every decision gets evaluated against this specific target. You know that when you reach that $48,000 annual dividend income, you've essentially achieved financial independence. Your investments are paying your bills whether the stock market goes up, down, or sideways. This specific target keeps you focused on income-generating assets rather than speculative growth plays. Having this concrete goal also helps you resist temptation. When someone tells you about the latest meme stock or cryptocurrency opportunity, you can evaluate it against your dividend income target. Does this investment help you reach your specific income goal, or is it just a distraction? If you recognize yourself in at least 5 of these 9 behaviors, you're already investing better than 90% of people. You're thinking long-term instead of short-term, you're focused on business fundamentals instead of price movements, and you're building systematic wealth instead of chasing performance. But here's what's really powerful about these behaviors. They compound over time. The more you focus on dividend income growth, the more patient you become with market volatility. The more you read annual reports, the better you get at identifying quality businesses. The more you automate your reinvestment, the more your wealth compounds without your active involvement. These aren't just investing techniques, they're wealth-building systems that work regardless of market conditions. And if you want to dive deeper into the psychological framework that makes these behaviors possible, check out my video on the psychology of dividend investors who escape the rat race. It explores the mental models that separate successful long-term investors from everyone else stuck in the short-term thinking trap. Like, subscribe and hit that notification button. I'll see you next time.